Let's bring in Christian Lawrence, Senior Cross-Asset Strategist at Rabobank. Christian, the message seems to be coming in loud and clear from the Fed presidents that they think it is time for a change in the bond purchasing program. Are we still basically looking at Jackson Hole for a keynote decision?
Well, that's certainly been the focus of the market for quite a while now, and we've seen some sizable positions being put on around that date, implying that some sort of a shift is expected. Now, I do think the Fed is going to be very clear here. It's going to telegraph things well in advance, and that is, of course, what we have seen over recent months. But we do need to put things in perspective here. 120 billion in additional purchases every single month is a huge number. So even slowing that pace down is still a lot of stimulus being added to the system. So I wouldn't call this a dramatic tightening in any way, shape or form. This is more about slowing down the pace. And I think the whole process is going to be very gradual indeed, as the Fed certainly doesn't want to spook the market. One thing's for sure, this isn't 2013. I don't see a taper tantrum happening.
Conditions mean, though, that we are incredibly sensitive to any modest shift in monetary policy at this stage. And I thought it was interesting that even as we saw a weak overall session on the S&P and the Dow yesterday, the financials seem to do better on the hope that we are now starting perhaps to think about a shift in the interest rate environment. What do you feel about the financials, and is there still an opportunity to buy them as we see this shift, or repricing, if you like, in expectations?
Well, of course, the financials do like a steeper curve, and that tends to be the initial reaction you see to any sort of tapering move, that we would see that 10-year part of the curve move a little bit higher in yield terms, and that is beneficial for the banking sector. I mean, in general, when we're looking at equities at the moment, it feels a little bit like tails I win, heads you lose, in that any move lower in yields is certainly beneficial for growth, for tech stocks. And we've seen that with some of the safe haven flows that have entered into the US Treasury market as a result of global Delta variant fears. And of course, we do need to bear in mind that the Treasury market is still that global safe haven of choice. But when we're seeing yields higher, driven by perhaps better growth expectations, then that tends to boost more of the value sectors, of course, of which financials is a huge part. So for now, it does appear that equities are going to remain supported despite these sizable moves that we're seeing in US Treasury markets. Has to be said that being a bond trader, a rates trader now is a lot more difficult than it was a few years ago.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.